Hi, everybody. Welcome to another OWA Live. I'm Gage with Oxford Wealth, here to talk to you about something kind of interesting that's happening in the markets right now. Let's see if we can dive in here. So the first thing I'm going to do, I'm going to open up a screen share here and kind of give you some information. So what we're concerned about right now is something called the yield curve. And before we even start talking about the yield curve, we need to identify what a yield curve even is. Some of you have already heard us talk about this because this is very current and relevant news. But what we're primarily going to be looking at are treasuries. So we need to focus on what a treasury is. And specifically, we're going to be looking at US treasuries. Now, treasuries are loans or bonds to the United States government. We loan our money to the government. They go and do things with that. That's how we build things, and that's how we balance budgets, and that's how pretty much the United States makes money nowadays, is with their bond portfolios. Those are called treasuries. Now, those are given over certain time periods. We can commit to leave those treasuries alone for a period of time. What we're going to be looking at today are the 10-year treasuries. 10-year treasuries. And we're going to compare those to the 2-year treasuries. If you had to venture a guess, which of those do you think would return more under a normal circumstance? If you guessed that a 10-year would return more under normal circumstances, you'd be right. If we commit money for a longer period of time, we should expect more interest. That just makes logical sense. When the 10-year treasury is more than the 2-year treasury, that's called a normal yield curve. We like normal. Normal is good. The markets like normal. The economy likes normal. There are times, though, where they are equal to each other. And when they're equal to each other, that's an event called parity. Parity is kind of the first warning bell that we see. When the 10-year and the 2-year reach parity, we start to think, okay, something weird is going on. And then every once in a while, the 10-year actually returns less than the 2-year. Those kinds of events where the 10-year is returning less than the 2-year is called a yield curve inversion. Yield curve inversion. And inversions are very important economic events that we pay very close attention to. Now, we're going to look at this here in just a second. Thankfully, we don't have to do too much work to find out what the yield curve is doing. The Federal Reserve already does that for us. So all you have to do is open up an internet browser and type in fred.stlouisfed.org. fred.stlouisfed.org. And then in their search bar, just type yield curve. One of the top results that you'll see is this chart right here, the 10-year Treasury constant minus the 2-year Treasury constant. What this shows is when this is above the black line, that's a normal yield curve. That's a normal trend. The black line is when they equal each other. That event is called parity. And as that line dips below the black line, like it did in August of 2019, that's called an inversion. Now, what's cool about this system is we can go through, we can click all the way back to like 1976 and see every yield curve inversion that has ever happened with the 10-year minus the 2-year. And what's very interesting about this is the Federal Reserve has noticed an interesting trend, and most financial advisors have noticed this trend. Anytime that the yield curve inverts, it is followed by a period of gray or economic recession. Economic recession is where the United States GDP, gross domestic product, like what we do, our income, so to speak, is negative for 2 consecutive quarters. If we have 2 consecutive quarters of negative GDP growth, that's how they put it. I know that doesn't make any sense, but that's what they call it. Then that's an economic recession. Those are marked in gray. Federal Reserve noticed that anytime that the yield curve inverted, it was followed by one of these periods of economic recession. So going all the way back to the late 70s, we saw the first yield curve inversion. Some of you may remember the gas lines, all the crazy interest rates, inflation, things like that were kind of out of control back then. That was all predicted by yield curve inversion that happened right before all of that stuff set off. If we go to a little bit more modern history, I'm going to skip this one in the late 80s. Some of you may remember the economic recession upheaval that happened through the early 90s. We're going to look at this one right here. So starting in yield curve officially inverted 0.05% in June of 1998. It then inverted again pretty aggressively following that yield curve inversion, but that kind of marked the end of the dot-com bubble burst. Some of you, especially those who are involved in tech and IT, probably remember that dot-com bubble burst because of how aggressive the markets were down and how quickly the markets or the economy responded to that. That was kind of an interesting time. We had the dot-com bubble burst, we had Enron collapse, and then right as we were coming out of the recession, the terror attacks of September 11th kind of hit us and caught us off guard. All of that kind of led to a 2 or 3 year slowdown in the markets and about an 18-month economic recession. You can see the yield curve recovered very quickly after that, but then starting in, January of 2006, yield curves inverted again. When those yield curves inverted again, well, we know what happened with 2008. We saw the crazy volatility that happened through that period. I'm going to zoom in here just a little bit closer so that we can see what's happened to the yield curve in the last couple of years. So I'm going to go in here. It's so fun with these charts. You can go through and take a look at any specific spots that you want. Yield curves inverted in August of 2019. That was kind of an exciting event. Rich Brady and I were actually teaching a college course in Cedar Park, Texas that week. I can remember the day that happened because we spent a good solid hour or an hour and a half talking about the yield curve and what it meant. We know what followed suit. We had an economic recession that came as a result of the COVID crisis. So far, this indicator has been pretty well spot on to identify economic recessions. Here's the fun part. It's always exciting to live through history. Yield curves inverted again on April 1st of this year. They actually inverted worse than they did previously. Now, the depth of the inversion doesn't really matter. At least we don't know what that means at this point. There's no direct correlation to say if the yield curve inverts heavily, then that means that we're in for a deeper recession. Just that when the yield curve inverts, that usually is an indicator to say, hey, pay attention. It stayed inverted for about 3 days. So this is something that we're paying very, very close attention to. This is a breaking development that I think a lot of financial advisors are looking at. Now, I know this video is getting a little bit long, but there's one other little factor here that I want to look at. So going back to my whiteboard here, we talked about the 10-year and the 2-year, but what about the 3-month treasury? 3-month treasuries are considered ultra short. What's very interesting is the 10-year minus 2-year yield curve usually correlates directly with the 10-year minus 3-month treasury. Usually those respond the exact same way. Let me show you what I mean with this. Our good buddy Fred here allows us to add additional charts. So I'm going to show you kind of how to do this here. We're going to click on add line, then we're going to type in here again, yield curve. And then once that shows up here, we've got the 10-year minus the 3-month treasury constant maturity. I'm going to click that. We're going to click add data series. And then we're going to get this out of the way so that we can see exactly what happens with this. Now, the blue line is still the 10-year minus the 2-year, but the red line now is the 10-year minus the 3-month. And you can see going all the way back to 1985, anytime one inverted, they both did. That's late 80s, and then here's the early 2000s, and then here's the mid 2000s, and then there's the COVID correction. What's really alarming to us is that they are not even close to doing the same thing right now. If we zoom into what's happening today, for the first time in history, the 10-year minus the 3-month is actually responding inversely to the 10-year minus the 2-year. We've never seen anything like this before. This is the first time in history that, in modern recorded history anyways, that we have seen a yield curve inversion on the 10-year minus the 2-year, but we have not seen a yield curve inversion on the 10-year minus the 3-month. What does this mean? I have no idea. Ultimately, when it comes right down to it, if you're concerned about market risk, if market risk keeps you up at night, we now have an indicator that has said, hey, look out, we've got potentially a recession on the horizon. I don't want to be doom and gloom, but honestly, if there's an indicator out there that has successfully guessed this right, we don't know. It's a guess for us too. But if there's something that's gotten, 8 out of 8, it's going to be something I listen to. The only thing you can control is the market risk that you take. If you feel like you are too aggressive, then let's sit down and talk to see how we can rebalance portfolios and remove some of that market risk, because ultimately that's the only thing you can control. We have to be very, very careful with how these things are being managed. Take less market risk. Now, that being said, there are always other opportunities. So we encourage you to call our office, give us a call, and schedule a visit to where we can sit down and review some of those opportunities. Anytime that we see something crazy like this is something that we want to pay very close attention to. Hey, here we are. It's time for us to start making some real-time decisions because some of those warning bells are starting to indicate. Hopefully this wasn't too scary. Hopefully you're not sitting here saying, oh my gosh, what do I do now? I'm going to be losing sleep until I talk to Gage or to Rich or to Lynn or to Brandon. Take that opportunity to learn a little bit more about the yield curve and now start paying attention to what some of those indicators mean. We are happy to help. We're here to help. Let us know if there are any questions or concerns that you have. We appreciate you guys. Thank you for watching the video and watching this installment of OWA Live. And until next week, we'll see you then. Take care.